Hello and a very pleasant morning, folks. I hope you guys are holding a cup of tea or a coffee as we dive right into the fresh view of financial updates with Almus Market Mornings and me, Shikhar Garg. Quite an interesting set of developments that we've been having and observing in the markets. Yesterday, Indian CPI numbers were released at 7.41%, a bit higher than what was expected, along with the declining industrial production numbers. But what's interesting to watch is the written explanation a central bank will now have to produce to the government, explaining 9 months of inflation beyond the admissible band. Mr. Das did mention it that it should not be shared publicly, but it's something time shall tell whether we'll get a glimpse of that particular written explanation or not. Another thing on the development side was the forward premiums. Forward premiums are having a lot of activity and volatility, uh, like spiking at the start of the week and then coming back only to the initial levels by yesterday. Now, rumors are heard of RBI receiving these forward premiums, reducing their forward book size. So, quite an interesting action, even though there's not much of developments on the interest rate side. Lastly, we heard the US CPI numbers are to be released. So, JK, I would like your comments on these forward premiums and the most widely watched number of US CPI. What should we be expecting? What's your take?
Hey, good morning, Shikhar. Actually, Japan and UK are actually grabbing maximum attention of the markets because the Japanese yen has moved into a new 24-year low at 146.90, and this is way higher than where they had initially intervened and spent about $20 billion. And now it's really not clear whether they are serious when they speak about containing yen's weakness with the currency already so weak from where they initially intervened. Probably, some statements indicate that they are not protesting the weakness, but only the pace of it. If that is so, and the market moves in an orderly way and not jumping crazily, it means it can move towards 150 as well. That's the question that the market is trying to answer. UK also had its own share of contribution to volatility. Initial statement from Bailey that they would stop buying bonds on 14th October as previously planned, followed by an FT story saying that privately they had communicated to some banks that they may actually extend it, and that helped pound to rally, as well as the 30-year gilts, which is closely watched, to fall by about 33 basis points. And this also gave some support to the overall global bond market. I have seen the 10-year and the 2-year US yields have also seen some profit taking, maybe because they are at good resistance levels, and also we have a CPI data today, although no one expects a CPI to really come down that much. Back on the UK, the GDP, industrial production and data, they were all weak, but the market was really focused on what's going to happen by the, Bank of England coming up, and also the UK government's own stand on the mini budget. There is some speculation, actually, very little mentioned, broadly, that there may be a more pushback on mini budget proposals, and somehow people are expecting a rollback of 1% cut in basic rate of tax back to its 2024 date, but retaining the narrative of wanting to cut taxes and also pushing back on plans not to raise the corporation tax. So these may be actually supporting the UK market, which means that the broader market tensions are actually prevailing upon the UK government to reconsider their proposals. Of course, we have the week's most consequential data today, where consumer price index of US will be released. Headline number expected to drop to 8.1% versus 8.3% last month. But again, holding above 8% is not a comfort zone, and a drop of a few points here and there is not going to really matter for FOMC. In fact, the FOMC minutes itself were released yesterday, where there was expression of concern about doing too little, posing more risk than doing more. So, which means they're actually okay to bring in some sort of slowdown in the economy rather than risking inflation remaining higher. And with economy still doing well, barring housing sector, they're very likely to raise rates by 0.75% in November and another 0.5 in December. And whereas this now actually market, which was initially looking for a cut as and when the stock market started to fall, and then started expecting a pause, and then now even a lower pace of rate hikes is seen as positive for the markets as well. Of course, I have to mention about the Japanese bond market, which takes best price for carving its own path, with yield standing stagnant with just below 0.25. BOJ's efforts helping, and reports say that there has been no trade in the 10-year bond market for the last 3 days. Really, that's something that we should not take note of when there is a turmoil of yields going higher everywhere else. We are seeing slight basing action in the short-term charts on the equities, along with some positive evidence, but that rather indicates some short covering rally ahead of the data rather than any change of trend as such. On the rupee, of course, nothing much to write home about, except that RBI's actions have contained the movement within 10 to 15 paisa. Yes, as Shikhar mentioned, they have been receiving forward. I mean, the RBI this is serving many purposes. One is reducing the forward long book, and then also the spot dollar selling, which may be creating some tightness in the money market, might be eased because of their buy-sell operation as well. So that is also probably there is some concern that the forward rates are going up in the offshore market, and the bringing it down here it might be a double-edged sword. It can pull down the offshore market, or it may be used as an arbitrage opportunity. One really has to wait and see which section of the market wins. As you said, the retail inflation edged up to 7.41 from 7.3 expected, and 7% recorded last month. It's a 9th consecutive month of CPI print above upper band now. Yes, they have exceeded the mandated higher band of 6%, and as per law, they have to submit an explanation. We'll see how this comes about, or whether government itself condones it in view of the special circumstances contributed by global factors. In the inflation itself, prices of vegetables were major contributor, by rising by 18.05%, and the food basket itself rose 8.6% from 7.62% in August. And what's worrying is that the CPI has been raising even with a fall in food prices, which means that even India is hit to broad-based inflationary pressures. With the Fed expected to hike by 0.75 November, and this higher CPI print, you will not be surprised to see RBI hike by at least 0.5%. I will personally be not surprised to see it hike by 0.75% in order to maintain the relative attraction of the rupee versus the dollar, where actually the differentials have been crashing. Also, some concern is that the industrial production for August contracted to 0.8%, contracted by 0.8% versus 2.2% previous month, and an expectation of 1.1% rise, which means that there is a slowdown in the core industrial activity. But right now, RBI may not be so much concerned about the growth aspect with the inflation and rupees, protection being utmost in their minds. So that's it for the day. We have lots of data. UK, deadline ending tomorrow. US CPI today, and then it will be followed by many central bank meetings in the coming weeks. Thank you.
Okay, wonderful, JK. And yes, there is some, actions by the central bank on the forward side as well, as JK mentioned. And we've also heard that RBI has asked banks to stop building positions in the offshore market, probably because the rising forward premiums across or differential in the forward premiums in the onshore and the offshore markets. But as JK mentioned, there is good likelihood with the food inflation rising and the rest of the inflation already having a high pressure on the Indian CPI, along with the rate hike of 0.75% by the US and the continued global pressure. There is good likelihood that we can see an interesting and larger than expected rate hike by our own central bank. So, folks, there is a lot of things coming in, even in the domestic markets, and I hope we are managing our risk accordingly. Uh, that's it for today, folks. We shall come up with another round of updates for you guys tomorrow, and probably we shall be thanking it's Friday tomorrow. So let's wait for tomorrow. Thank you so much for listening today.